Okay, guys, let's take a look at the direct method really quickly. So for the direct method, you always start with the income statement as it's presented. So on the income statement, we know that we have sales and service revenues, investment revenues, and then non-cash revenues and gains. We get down to our expenses. We have our cost of goods sold. That's the cost related to making the revenue. Then we have our operating expenses, which is salary, wages, rents, kind of like any of that general administrative expenses. We have non-cash expenses and losses, which we're not really worried about, such as depreciation. That's where that would be found at. Then we have interest expenses and tax expenses. That's interest expenses, interest paid out to the lenders who have lended us money. Tax expense is taxes paid out to the authorities, the taxing authorities, the IRS or the government. So looking at it for sales and revenues, we want to make sure that we have this on our direct method as cash inflows because this is cash received from customers. We have to make sure that we are only taking the cash aspect of what was received. So we will have a balance sheet component in this to where we would have to go through and look and see, okay, do we need to remove some of this revenue because we've recognized it as revenue, but we haven't received the payable yet. We haven't received the money from the receivable. Since we haven't received that, we haven't received the cash, so it does not need to be included in our statement of cash flows. Here we have cash received from interest and dividends. That's interest payments made by the bank. Let's say we have a lot of money sitting in a money market account or something like that, and they're paying us interest daily. We will report that as a cash inflow under investment activities. Non-cash revenues or gains, they won't be reported. Anything non-cash related will not be reported on the statement of cash flows. So then we want to look at our cash outflows on our statement of cash flows. So cost of goods sold, this is if we have inventory, if we have parts that we're using to make the product that we're selling, anything that goes into making that product that we're selling or that service that we're providing, we want to make sure that we have that in the cash outflows because that is cash directly related to making revenue. For those operating expenses, we want to make sure we subtract those out as well because that's cash paid for rent, salary, supplies, and that actually has to do with the operations of the company, right? We can't sell our product if we don't have a warehouse to store our goods in, right? So that would count as a cash outflow that would be calculated in the statement of cash flows. Non-cash expenses, depreciation, amortization, depletion, any of those non-cash items, they will not be factored in. So we would just basically not include those when we're calculating the amount of the cash inflows for operating activities, the net amount of cash inflow for operating activities. We want to include those interest expense payments, that cash paid for taxes, any cash that went out the door. We want to make sure we include that. And then this will help us get down to our bottom line, which will be our operating activity income. Oh, this is a bad marker. And that's pretty much it for the direct method.